Financial planning tutorial part 3. We're going to talk about the tax planning now. So we're going to go into taxes, and then we'll do the retirement tab, and then we're going to run a financial plan as well. But this will just be part 3 of the taxes. So stay tuned for the other videos because we're going to get a little bit deeper into that. But we want to build up the process so that our good friends here, and I forgot their names, Bob and Jane YouTube, can have a full-fledged financial plan that you can witness. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn about the software that I use when conducting financial plans. It doesn't mean it's all-inclusive. There's no other software out there that you should use, but this is what I like, and I think you'll like it too when you see what I'm looking at. So let's dive right into it. So Bob and Jane YouTube, and we've already gone over the dashboard investment, insurance, estate. So right now we're going to go in the tax scenario. So remember, they're going to retire next year, all right, and then they're going to have RMDs, required distributions, because all they have in assets is their house at $400,000, and each has $250,000 of IRA or 401ks. That's it. All right, so nothing fancy here for Bob and Jane YouTube. We're just going to kind of go over what the scenario looks like before we do any planning specific for these guys right here. So as they're working, what you can see is, and this is what I love about the software, it kind of breaks it down. I'm very visual. I like visual stuff, which is why I love YouTube. So what we see here is we see they have FICA tax because they're still working. They're work for one more year, and their FICA tax is, what does that say, 6.7. They go down here, they got state tax at 4.8 because they live in Georgia, and they got their Fed tax at 10.7. So all in, they're paying about 21 or 22% in taxes on their income. Now they retire and they go to the age of 68 and they got nothing. They got no taxes whatsoever. So let me pause there. What jumps out at you for opportunity right there? Anything jump out at you? Shh. Opportunity 68 to, what's that, 72. No taxes at all. How come they don't have FICA? Because they're not working. How come they don't have IRA, or I shouldn't say IRA, local or state or federal tax? Because they literally have no income. They got no income in these years at all. Now we fast forward up here and they start having some taxes. Why? Because required distributions. Why did they not have taxes there at 71? Because they still have RMDs, because they have higher standard deductions to offset the required minimum distribution, so they have no taxes. And remember, I talked about this in one of the chapters of my book, The Tax Bomb in Your Retirement Accounts, where I talk about how your team, chapter 15, how your team can take advantage of the tax code, where we talk about using the standard deduction to offset any kind of income that you have, and that way any taxes that were withheld, you can get it back. So it's very, very important to understand the standard deduction. But now that they're both retired, they both start having RMDs, we see their tax rates go to 2.7, so it's still nothing fancy here. And then it jumps up right here, and we'll get to why that is here in just a second. So that's the tax code, or that's the visual of the taxes for these guys. And I like to see this right here, that little not a gap, I guess the valley, if you will, of little to no taxes. So let's go into details. And now this will be awesome. This is why I love this software. This is why this software is the best, because here you see a good 1040. The tax return 1040. Now, again, in 2019, this will look different because we've already been notified by the IRS that they're going to have a simplified version of the 1040. We don't know what it looks like yet, but in 2019, it will not look like this. Look something differently. Theoretically, be simpler, but remains to be seen. All right, so we have the 1040. We have the Schedule A, and nothing. I mean, we'll talk about that here in just a second. We got the Schedule B. All right, so Schedule A is your itemized deductions. There are no itemized deductions for these people. Schedule B is your interest. All right, you can have your interest in ordinary dividends. So there is no interest in ordinary dividends here. We have your schedule. There's the Schedule C if you're self-employment income. They're not self-employed, so there's no Schedule C. We have Schedule D, which will be your capital gains, if I'm not mistaken. Yeah, capital gains and losses. There are no capital gains here because they have everything in IRAs. And then if you have AMT, alternative minimum tax, you'll see that here. There is no AMT because under the new Trump tax bill, the amounts that require the trap that more and more people got sucked into for AMT have been greatly increased. So the AMT rules are not going to affect many people until the tax law sunsets, and I think it's 2026. So you got to keep your eyes to see if that comes back, because if it does, it'll be forceful. But from now until 2026, you don't have to worry about the AMT. Most taxpayers. And then we got taxable Social Security sheet, which, man, I love. So we'll go into all these, but I just want to show that to you. This is just fantastic. All right. So and then we can go back and we'll say, what's their tax looks like in 2041. We'll dive into this just a short. I just want to show it to you. And we start with the schedule, the 1040. Oh, my land's too quick. There we go. Schedule 1040 in 2000. Then we got to change this around, and we can pick any day. So 2041. So it's awesome. And you have access to this too if you sign on with Right Capital Software. You do it through me. I'm happy to give you a link to this. If you want me to analyze it, we'll have to work on fees. But for me, I mean, this is just phenomenal. It's phenomenal. It's the best software there is for this. I love it. All right, so let's go back to 2019 to go over the method to the madness of Bob and Jane YouTube of their income. So line 7, they got 105,000 of income. We already talked about that. They both make money. They're both working. All right. They have. Do we have them taking Social Security? Well, I don't remember that. Did they have them taking Social Security in 2019? I thought we delayed that. Oh, I guess we didn't change anything. We just initially had them taking Social Security in 2019 because we haven't done any planning yet. Okay, that makes sense. All right. So in this case, this is just this isn't the proposed plan. This is just the way we put it in initially, where they're going to retire and then they're going to take Social Security. Bob is when he hits full retirement age. That's what it was. Okay. And so between their wages and then their Social Security, they have taxable income, or total income of 120, not taxable, total income of 120,000. And then we go down here to all right. So remember, the AGI, all right, this is your line. So anything above this is your above the line deduction. So from adjusted gross income line 23 down to 35 is your above the line deduction. So you do not need to itemize to get deductions up here because they're above the line. And then this first section of your 1040 is your income section, where you have all your income and you combine it all, you get that. That's 120. Then you take your 120,867, you subtract any above the line deductions right here, and that gives you your total adjusted gross income. Now we come to page 2, and then we're going to say, okay, that's our AGI, 120,867. Now we have standard deductions of $25,300. Jane's got a $12,000 standard deduction because she's under 65, and Bob's got a $13,300 standard deduction because he's over 65. So we subtract $25,300 from 120, and that gives us our taxable income right here of line 43 of $95,567. And we go into our trusty tax calculator, which I'm not going to do because they've already done that for us. Hey, and they're going to pay $12,904 in federal taxes. All right, so you with me so far? Now, the one thing I don't like, and where eMoney, which is another software, is a little bit preferable in that, is eMoney is a little bit better for state taxes. Right Capital, not quite as fluent on state taxes as eMoney is, but it's worth this Right Capital versus another program called eMoney, even though eMoney is a little bit better on state taxes just because it's right here. All right, and they're working on it. So $12,904 is our tax, as you can see by line 44. All right, so that's a 1040 of their tax bill, and you just see, you can see all this stuff right here. All right, so they don't have any itemization. All right, so let's just keep going now. So it's 1040 Schedule A. All right, that's going to be your itemizations. There is no itemizations, and what we do is they have nothing here. Medical and dental expenses, they have none. They have $10,000 of income, $5,000 of real estate taxes, and $5,800 of state and local taxes. All right, so that's called state and local taxes. And so remember, the max you can have is $10,000 here. That's the max you can have under the new tax law. And a lot of the people in the high tax states are just up in arms about that. But that's it. So you can't have more than $10,000 here. You could have less, but you can't have more. At the end of the day, it doesn't matter for these guys. They got no interest paid in terms of mortgages, home mortgage interest, points, all that. They're not tithing, no gifts to charity, nothing. So in this case, they have even though they could have $10,000 of SALT, state and local taxes, it's not enough to itemize because their standard deduction is $25,300. So if this amount on itemized deductions is anything below their standard deductions, it's a moot point. You're not going to use it because the standard deduction is $25,300. You need to have more than $25,300 right here in order to itemize, if that makes sense. And that's a challenge because most people in the hit retirement are not going to itemize because a lot of them no longer have mortgages. All right. Now they might be giving to charity and tithing, but a lot of times they have no income or very little income. So their tithing typically goes down. And then now they might have more medical and dental expenses, but generally speaking, it's not going to be enough to offset their lack of home mortgage, their lack of a huge significant amount of tithing. And then again, they're going to have less income taxes for sure. And a lot of times less property taxes because they're going to downsize too. So even though this one might go up, these other three go down. And then generally speaking, they're going to itemize less and less as they hit retirement. All right, so let's hit Schedule B, which again is going to be the interest and ordinary dividends. You're not going to have anything if you don't have anything that's out, if you don't have anything that's outside of an IRA, 401k, TSP, 403b, variable or fixed annuity, life insurance. I mean, anything that's in a tax preferential account won't give you an interest or ordinary dividend. It just won't. The only time you're going to have interest and ordinary dividends, CDs at the bank, dividends from, you own a Southern company here in Georgia, something like that. But I mean, in this case, you don't have any. So that's good. Now, I would say, as you're looking at your own taxes, don't overlook Schedule B and Schedule D. I'm telling you, both these things are huge because there is planning opportunity there. I tell that to people all the time. I need to see your tax return with the schedule so we can get an idea of what we're looking at for Schedule B and Schedule D, which is capital gains and losses. And again, they don't have anything because everything's an IRA. Now, I do want to just real quick go back to show you your 1040. You can see some of this on your 1040 as well. If you see line 13 right there is capital gains. All right, you see line 15 is IRA distributions, and line 8 and 9 are dividends and taxable interest. So you can see taxable interest, tax exempt interest, dividends. So 8, 9, and 13 is the information any tax person or financial planner should be asking for, because if we have big items there, we have tax problems, no other way around that, and we have planning opportunities for sure. So let's go down here. There is no AMT, so we're going to skip over that. But here's the taxable Social Security. All right, so enter the amount that he got from Social Security. So he got $18,667 from Social Security. We enter. Remember, we did all this with a provisional income. So what we're trying to calculate here is our provisional income. So remember, the most you can pay on your Social Security benefit, the most amount of your Social Security benefit is taxable is 85% of your Social Security benefit. All right, that's it. You can't pay more than that or have more than that taxable. So given that their combined income is $105,000 plus the half their Social Security benefit, I can almost guarantee you. In fact, I can guarantee you that 85% of the Social Security benefit is going to be taxable. I can guarantee that because their combined income, i.e. their provisional income, synonymous, combined and provisional, is going to be well above the threshold to make their full benefit of Social Security taxable. And again, that's 85%. And so what we do here is we just enter one half of this. We add all their other income. That gives us a total income right here. Total combined income, and then we go down to the thing. The first $32,000 is not subject to any taxation. The next $12,000 is $6,000 of that is going to be added to your provisional income, and then any amount above $44,000, 85% of that will be added to it, and to a max of 85% of your total Social Security benefit. It gets confusing. I've done tons of videos on this, so I don't want to dive too deep into it here. But you can see the numbers here, and this right here is the amount between $32,000 and $44,000. We take half of that, which is your $6,000. This is the amount that's left over. We take 85% of that, which gives us this. We add $59,000 and $6,000. We have a total Social Security benefit taxable of $65,783, but that's way too much because the most that we can have is taxable Social Security is 15 or 85% of this amount here, your benefit. And so we take the lesser of the two, of the $65,783 or 85% of your benefit, and that will be our taxable Social Security, which is $15,867. Now, if we go back to our 1040, we'll see exactly how that shakes out. And we take our 105 and we add our taxable Social Security. So our total income is 120,867. Confusing, huh? Clear as mud, huh? You'll get used to it. You'll get used to it for sure. All right, so that's the projection of taxes in 2019. We can project these until, again, we'll go to 2040. What do we do 2041 before? So let's go and project it here. A couple things jump out. They no longer have wages and salary, but instead they have taxable interest. They have some tax exempt interest. I won't dive into that right now. I don't know from where that's coming from off the top of my head. We have to dive into it, which makes it planning fun. They have some qualified dividends. They have a little bit amount of capital gains. They have significant IRA distributions. They have total Social Security benefits of $45,449, which is that. Let's take our trusty calculator, 45,449 times 0.85. And that is, that's 85% of 45,449. So we take 85% of our Social Security. We add our IRA distributions. We add our line from Schedule D, our capital gains. We add our ordinary income or dividends. We add our taxable interest. We add all this together. And then we have total income, $98,948. We have no above the line deductions. And so our AGI, which is the number that we're trying to shoot for to find out where everything is driven from, is $98,948. Again, this is year 2041. All right, so here we take our itemized deductions. Now, interesting, here we have itemized deductions of only $13,256. But Josh, you said their itemized deductions once they hit 65 will be $26,600. What happened? Well, Right Capital, they realized that tax law, the Trump tax bill, sunsets, and again, it's 2026, I think. And because of that, we're going to revert back to the Obama tax rates, all right? And so this is exactly what's happened. Now, we lose a bunch of standard deductions, and this has also been inflated too. So you can see where the standard deduction, how low it is, because this is 2041. And that's a little bit more than half of what the standard deduction was in 2019. In 2041, the standard deduction is only $13,256, even though it has been inflated for inflation. Now we have exemptions though. We get an exemption per person of $39.50 per person. So we do get exemptions, which we add to our standard deduction, and that gives us, we subtract $98,948 from our standard deduction, or we subtract our standard deduction from $98,948. It gives us that, which is then we take our exemptions, which gives us our taxable income of $78,548. In that case, we pay $11,710 in taxes. All right, so that's the difference. I'm just curious. So we have $98,948. Let me write that down because I want to do a comparison real quick. We pay $11,710 on $98,948 of AGI. Let's see what it was in 2019, because this once and for all will stop the idea that the tax cut only favored the rich, because it did not. Here we pay $12,904 in taxes, $1,200 more on 22,000 more of income. So here we have of AGI. So here we have roughly 121,000. Yeah. So basically we have 22,000 more of income, and we pay 1,000 more in taxes. So let's see what that says. 1,000 more in tax divided by 22,000 more in income. That's a 4.5% tax rate. So as you can see, we pay only 4.5% more in tax for having 22,000 more in income on 98 and 99,000, 22% more in income. So we have 22% more in income this year, but you only pay 4.5% more in tax. So that's because of the Trump tax bill. Regardless of what you think about Trump, the facts are it does not only affect the wealthy. That actually drives me up the wall. I don't care what your politics are, but I mean, let's be real here. That did not affect the wealthy more. I mean, it does more so simply because wealthy have more money. It is a huge benefit to the middle class for sure. There's just no other way around that. So it drives me crazy when people say, it doesn't benefit me, so I'm not going to do any tax planning. It's just silly. Don't do that. All right, so that's 2019. Now, not done yet. All right, so this is the tax thing. So now I want to show you this. Boom. Again, we're going back to the visual because, again, I love visuals. Now, why? This is, I love this. All right, so we're going to go down here to action items. All right, so you can see that gives us the showing of their tax bracket. All right, so we're saying this is the two highest tax brackets. The orange up here is a 24 to 28%. It's hard to see with this thing doesn't get out of the way. We got this bracket right here, which is the 22 to 25%. We got this bracket right here, which is the 12 to 15%, again, because we're using sunset provisions. And then also in terms of capital gains too. All right, so anyway, at the end of the day, so we got the low tax bracket right here, 10%, 12%, 22%, and 24%. All right, does that kind of make sense? So why we're showing you that, because that is where we want to fill up the buckets of the tax brackets, potentially. And so watch this. So we go down here and we say we're going to go sequential withdrawals. We're going to draw from taxable accounts and tax-deferred accounts, then tax-free accounts. All right, but that's not really care. What we're going to do is we're going to say we want to fill up the tax bracket with Roth conversions. All right, so watch what you're seeing here, and we want to fill up the 12% tax bracket. And now what they're doing is they're saying, okay, we're going to take Roth conversions, because remember, when we go back, we got no taxes. We owe. I wish that box would get out of the way. I can't really do it. We got no taxes here. Nothing. Zeros across the board. Nothing. And right now, that's our tax bracket. We're just a little bit above the 12% bracket because we're working right now. But now, watch this. We want to fill up the bracket of the. We want to, and there's a 10% bracket. We're going to fill up the 10% bracket right there with Roth conversions. But I want to fill up the 15% bracket. So what you can see here is now I'm adding to the taxes by making Roth conversions to some of my money right here. So I'm converting adjustable taxable income with conversions, $81,000. If you can, it's just hard to see. Can you see? So hopefully you can see that. It'll say right there, 68 years old. My adjusted taxable income with Roth conversions is $81,318. Now look at this chart right here, this little pop-up box. If we look down, if we fill the 22% tax bracket, my adjusted gross taxable income with conversions would be $173,000. See how that works? If we don't do any conversions, our adjusted taxable income will be zero. All right, so this is just fan. I love it. So we can go over here and let's see what we can do here. Right there. Right now, our adjustable taxable income with and without conversions, because remember, I'm just converting down here to fill up the 12 and 15% bracket. Well, I'm already in the 12 and 15% bracket, so there's nothing to fill up. So here, our adjustable taxable income is $95,000 with or without conversions. 10% bracket is $19,000, so it just gives you a tax bracket. So now we go in the next year, and we're doing a conversion. Our adjustable taxable income without conversions is $18,864. If we want to do the conversion to fill up the 12% tax bracket, our adjustable taxable income is $79,335. So you can see that. Now watch what happens here. All right, so here we got proposed strategy. This is not doing any, all we're doing here is sequential withdrawing. We're withdrawing from taxable accounts first to make up an income gap. We have no taxable accounts. Then we're drawing from tax deferred accounts to make up the income gap. And lastly, we're drawing from tax-free. So we only have tax deferred. So right now, the proposed strategy doesn't mean anything. If we change this back to pro rata, where we're just kind of taking across the board, we're not, I mean, again, there's just nothing really here because we don't have anything for accounts. We just have an IRA. There is some in the long end of the scheme here when you're 88 and 89, there's a little bit of benefit, but it's not worth. I just don't want anyone to get too caught up in this right here. What I do want you to get caught up is this right here. All right, so now by filling up the buckets to the 10%, all right, we have 31,000 more in proposed tax adjusted ending portfolio than a pro rata withdrawal strategy without conversion. Now we can go back here, do a sequential, and that's so it's just the whole thing kind of combines. So what is happening now is because we're starting to do tax planning, we're starting to do Roth conversions. We want to withdraw from taxable accounts first, then tax deferred accounts, and then lastly tax free. However, we did pro rata because now we're starting to have some IRAs and Roth IRAs. We're going to lose 18,000. Remember, it's 49,000 up here. Now it's 31,000 because we're taking it basically a third. We're taking a third from the tax deferred accounts, a third from the taxable accounts, and a third from the tax free. We don't want to do that. It's proportional. No way do we want to do that. We want to leave the tax free accounts alone as long as possible. And so by just filling up the 10% tax bracket with Roth conversions, we have 49,323 of tax adjusted ending portfolio value. Now let's see if we go up to the next bracket. Look at that. Now we got 85,490 more of ending taxable value because we're taking advantage of our low taxes here. I hope that makes sense. I don't think it's typically when you go too far, it's usually not that beneficial. Let's see. Yeah, no, okay. So here we're saying we're going to fill up the max brackets and we're going to lose 212,000 simply because we're paying too much. There's just no other way around that. So we don't want to do that. So let's go over here, and here's a 22%. Yeah, so you can see there is an efficiency number here in terms of how much we want to convert and when to convert. So we want to convert to fill up the 12 and 15% tax brackets as much as we possibly can, and that will increase our tax adjusted ending balance by almost six figures. I mean, without doing it, we haven't changed our investments, we haven't done anything, just proper tax planning. Now, here we got something called estimated terminal rate. Is applied to balance of tax deferred accounts at the end of the projection. Essentially, what are you going to leave to your heirs at your death? 25%. I mean, we can do whatever we want here. Let's say we said 10% is going to be more. So if we had what's going on is the amount of taxes that are left over at the end of your death, if that makes sense. So we can dive into that at a different detail. Right now, I don't really care. I care mostly about this right here. All right, so if we do a little bit of tax planning, we get a decent benefit. If we do a little bit more tax planning, we get a six-figure benefit. And it's wonderful. It's a wonderful tool. I love this. I mean, I could sit here and mess around with this all day long. All right, so but that's not it. Now we compare. So we compare against the proposed strategy against our current strategy. So if we have a proposed strategy, we have $914,000 of tax-free money at our death. If we just leave a well enough alone, we're going to have $876,000 of ending portfolio at our death with nothing tax free. I don't want anything tax free. I want stuff tax free. That's for sure. We can play these numbers till we're blue in the face. So here's our withdrawal strategy. It's just awesome. I love it. And here's our account balances. You can see we have taxable is blue. We see with taxable is dark blue, tax-free is light blue. And then we have our IRA, which is orange. And here we got taxable because every time we're taking distributions from our IRA, it's got to go someplace if we're not spending them. And because we're having a plan on Social Security distributions, we're not spending it, it's got to go in there. We'll talk about that in the next video when I do the cash flow stuff. But oh man, look at all this stuff. I mean, it's just phenomenal what these guys can do. And again, they just go back to withdrawal strategy from where is the money coming from? Of course, it's coming from your tax deferred accounts. That's all you got. Later on down the road, you're going to take some from your taxable accounts because remember, we did the sequential, taking it from tax deferred, then we're taking it from taxable, and we're never touching Roth. We're never touching tax free, which would be light blue. Anyway, I guess let's just show the pro rata real quick while I'm thinking about it. This might bore you. I love this stuff. Oh my goodness. There we go. Let's see. All right. And so here you can see pro rata. There's no tax-free stuff over here. Let's do pro rata over here and see if that changes anything. I bet it won't. Oh yeah, there is. So we're taking tax-free out because we're doing it again proportionally. It's stupid to do. We don't want to do that. So let's just go back to sequential. All right. So lastly, we have our details. And this is, all right. So here we're showing you the conversion amount. We're converting 47,295, 35,405, 55,859. And that's going to fill all those tax brackets up. We have 4,600 from a taxable account as distribution, taxable account balance. And it breaks down tax deferred account balance, taxable account balance, tax-free account balance. Frankly, I was still, because they're hitting RMDs, for some reason, I got to figure this out, but it's easy. They have a stopping conversion here because we're hitting the RMD phrase. I don't know why we would do that. I still want to convert, frankly. And we can. It's the system, the initial proposal is stopping at 7 years old. And I don't want that to happen. I want to keep going because it's going to be looking even better. All right. So here's the, was going to show you here the tax amounts, income from taxable, tax-free, income from tax-free, income from tax deferred. Okay. This doesn't tell us the tax. It just tells us the distribution conversion. So we converted, that's pretty good money right there. That's $150,000 We converted $150,000 to tax-free. Tax-free balance is $521. Tax-deferred balance is $341 at death. And the taxable balance is $85,733. Not too shabby. Income from tax-deferred accounts, $35,771, because again, we're keeping it in the 15 to 10% bucket. I would much rather have, let's just put it this way. I want to convert more than what the system is showing here right today. I'm just showing this as an example. So that's the tax, folks. It's awesome. As you can tell, I love this. I think I'm a huge fan. So hope this helps. I'll post this. And if you have questions, thoughts, comments, put it down below. Thumbs up always, comments below. I'm happy to provide you the link for this. I don't think they give me any number of people that can get this. Just remember, if you sign on to this, I can see all your stuff, and that might be something you don't want. But just think about that. But I mean, it's just fantastic. So I don't think you can buy Right Capital software on your own. If you want to do it where you have it all personal, where I can't see it, I would go to Larry Kotlikoff's, which is maximize your Social Security, maxfiplanner.com, esplanner.com. I forgot what it is. The Kotlikoff stuff is just awesome too. I haven't done a detailed run of it, so I don't know what the Kotlikoff stuff looks like. It's $40 a year, man. It's awesome. I don't think it is quite as in depth on the tax side in terms of being able to visualize stuff as what this is. But from a Social Security perspective, you just can't beat it. It's wonderful. And it does a different little bit of accounting mechanism too in terms of cash flow. But in terms of tax stuff, this is why I went with Right Strategy. For me, I need the visual, and this does. All right, subscribe, thumbs up, comments. Don't forget to go to the blog at heritagewealthplanning.com, and we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.